can't go live, man. Oh shit, everything's different.
Hold on.
So hey guys, sorry, the StreamYard changed everything this morning, and so learning new software took a minute, but we are here. I'm excited to be here with Ian Cully, man. We haven't gotten a chance to talk with Ian for a while, but a great person to come on today to talk about commodities, inflation, bond yields, everything in fixed income, currency, commodities, equities, you name it, we can talk it all. So what's up, Ian, man? Great to see you today. How have you been?
I'm doing well. Thank you. Thanks for having me.
I'm so pumped to have you, dude. This is a great conversation. We were talking a little bit off mic about what Ian's looking at. It's very similar to what I'm looking at. And starting off, we're talking about yields today. So we're going to talk about inflation, yields. We'll talk about energy. We'll talk about all these different commodities, what we're looking at, where we're at in the macro market cycle, what it means for equities, cryptocurrency, you name it. We'll talk it all here. Let's start out first looking at this one. This is a massive, what is this pattern? 40 years, you got 40 years. So basically 1942, you had the bottom in yields in the 30-year treasury or 10-year treasury, any way you look at it, really. And that bottomed all the way and made a top in 1982. The 1982 top coincided with equities bottoming for the next, 40 years. So basically equities bottom for a long time, and then we get to a bottom the other direction, and that was in 2020. Basically, the Fed comes in, does unlimited QE. They cut rates to zero. They hold it there for a while. They give money to anybody with a pulse, basically, in the United States. And here we go. We're taking off to the upside after 2020 in inflation, and yields go with it because yields are also priced with inflation. So, looking at this chart, Ian, give a big picture view of what you want to talk about today, because I'm thinking about, all these commodities out there, the ones you've been talking about, the ones you're bringing up today. What are we looking at? Do you think we're heading into more of an inflationary cycle? Do you think it's more of a, nothing burger? Maybe yields go back down and that's the end of it, and commodities are dead and the commodity super cycle's over?
No. That the commodity super cycle is definitely not over. I do believe that yields are heading higher, that we're about to enter another wave of inflation. We're about to get hit by another wave of inflation. And this chart here, this is an amazing chart. I actually haven't looked at the 30-year yield going this far back to the 40s. Yeah, we've seen the trend reverse. Again, yields are heading higher. The commodity super cycle is not dead. What were we, 5 years in? Even if you start the cycle when gold broke out in June 2019, we know that these cycles tend to last 10, 15 years plus. So there's gold is ripping. It's, above 4,000. I can see where some investors would see that as a top, or that it's extended. Yes, in the near term, it's extended. Silver breaking out to a new all-time high, back above, not back above, but getting above 50. People see that and they're like, "Oh, it's over," and it's not. It's not over. And I brought some charts today to kind of share and maybe expand some investors' minds about what's actually possible in the coming 5-10 years. But yeah, it really comes down to rates are rising. Inflation hasn't gone anywhere. Commodities are going to be heading higher, and we just need to think about how high could some of these commodities go, and when they do, what do we want to be buying in the stock market?
No, great point, because I think we're in this cycle right now, and everybody, the thing why I keep bringing up yield so much is because everybody, basically every time I bring up the fact that yields are going higher, everybody thinks that that's ridiculous. The Fed's cutting rates, there's no way yields can go higher. But I just want to point everybody to this chart, which is yields dancing together higher all at once. Yeah. So the Japanese 30-year actually hit a new high recently. something I wrote about this week. Really important post. If you guys, because everybody was that day, I think it was Wednesday, I wrote that, and everybody was focused. I think that was the NVIDIA earnings.
Yeah, it's funny. It's funny. I read that, and it was a great post. And I had written a note the day before about NVIDIA.
Yes.
I got a crack about it. I just had to laugh because no, your post was spot on, and it's outstanding. And yeah, rates are rising worldwide,
across the board,
worldwide, and the pound or the gilts, gilt yields are pushing towards new highs too, and it hasn't that underlying trend has not changed, right? The structural downtrend in bonds in U.S. Treasuries has not changed. So it's really hard to shift in terms of a structural outlook on bonds, on yields, on inflation, and on commodities. So
it's all moving together. It's all moving together, and I think that's something that people. When I always say things, I always say this all the time, and people who've been watching for a while knows this. I say it's all one trade, and one, it's like when you look at a portfolio. Number one is as a trader, my job isn't to be like, look at my really sweet one trade I did. People will come on my Twitter or wherever and like mess with me, be like, oh, you got this trade wrong or whatever. That's been happening, since I started trading, which is normal. But people don't understand, like, it's the portfolio as a whole, as one thing building together. And why I'm mentioning that right now is when we're looking at yields, like yields moving up means that energy should do well, means that gold should probably continue to do well, unless they get really out of control. But for now, I'd say gold, silver, precious metals should continue to do well. It also means copper should do well. It also means industrial stock should do well, and material stock should start picking up. They're getting weighed down heavily by underperformance from the chemical stocks at the moment, but materials should start to do well. International stock should do well. So what I mean by that is all those are really one trade, all tied together by this rising yield environment. We're in a rising yield environment, which means we're in an inflationary environment. Yes, we'll have periods of time where it slows down. Yes, everybody keeps pointing to oil like, oh my God, look, oil's not moving. That must be the end. And it's like, if you look at under the surface, like how many of these sectors have already started to take off? Mm-hmm. I mean, it's across the board. If we're looking at gold miners, silver miners, explorers, we're looking at palladium and platinum miners.
Yeah.
All those are moving. Then we're looking at uranium. That's moving. We're looking at lithium miners. That's moving, even holding relative strength compared to the market at the moment. So coal stocks are starting to move.
Yeah, I was going to say coal stocks.
One or two fertilizer stocks are starting to move. It started to look like it was bottoming out as a whole, but now it's only like one or two really starting to move. Sorry, Sam. I did mention that to Sam, like, hey, this is awesome. Check out these fertilizer stocks. And then like the next day they just got blasted.
Well, I think Sam's just maybe 3-6 months early.
Well, it was me. I was looking at it and I told Sam it. So
okay. Well, yeah, like I'm with you. I think that's part of the rotation a little further down the road. Especially when grains, like when wheat starts to dig in and corn's looking good. But it's really about beans right now, for the grains. So when the rest start to join, I think those fertilizer stocks, all those ag inputs will start catching a bid. But yeah, I mean, I think energy looks great. It just depends on your time frame, and how what your strategy as a trader, as an investor, what that is. I think maybe towards the end of the year, early next year might be a good time to start moving into the energy space and buying some energy stocks. But I think there's a rotation afoot. There's definitely some selling pressure hitting the stock market, and hey, that's all right. I don't think the rally's over by any stretch, and I think yields heading higher. It's actually supportive of risk assets across the board right now.
Yeah.
And it's all about following that rotation in the next couple months.
Yes. And I think this chart kind of says it all too, which is you don't have to, because the Fed is lowering rates doesn't mean the 30-year has to move with it. The Fed controls the short end of the curve. That is these 3-month bonds basically are what they're tied to mainly. Anywhere from 1 month to even 2 years, most of the time they have control over that. But if you're looking at like 10 years to 30 years, they don't have control over that, which is why we're seeing this divergence here. For that, it's basically, to me, this is the 30-year yield calling bullshit on what the Fed is doing. And I agree with that completely. I think even Powell agrees with that, which is until, Trump kind of jumped in and until like people started getting fired or their jobs threatened, we basically had hey, we're not going to be lowering rates. Inflation could come back. That would be a problem. So we're just going to hang tough here. And then all of a sudden, everything changed, and everybody went, well, I guess we got to start cutting rates immediately right now at the next meeting. That was after a firing. That was after Powell's job got threatened once again. And now we're here today, and the 30-year yield is starting to bounce off of this level and continue to move higher. So I do think I think the smart money, if you really talk to people who've been trading a long time, like I'm not talking about me, I'm talking about people like who've been Druckenmiller, Tudor, people who've been in the game for 30, 40 years.
Yeah.
They're all talking about higher yields too. But if you talk to like normal people or people who don't know the bond market very well, they're talking about yields going lower.
Mm-hmm.
So I'm just kind of pointing out here, like, I still see this scenario being very inflationary, and they could do whatever they want to. They could use quantitative easing. They can continue to lower rates. Like, I think inflation's just going to take off. And I think even more so if they continue to lower rates or try to suppress the curve. I think inflation will take off.
Yeah, absolutely. I think what's really interesting about this chart is just looking at the 30-year yield and how it's in the upper right.
Mm-hmm.
It's in a whole nother area of this chart that, was not even, really wouldn't have been in the picture until 2022, right? And when we see the Fed funds rate roll over in 2019 and the 30-year follow, I mean, that was in an environment where, I mean, what was the inflation rate then? I mean,
in 2019?
Yeah, it's not. We
it was
weren't
under
in the
2%.
Yeah, we weren't in the same inflationary environment that we are now. So when the Fed cuts and it eases, it's just adding liquidity to an inflationary environment, and that's just going to send risk assets higher, and it's going to inflation is just going to keep. It's just not going to go anywhere. It's sticky. It's still sticky, and it will remain sticky. And when it comes to cutting rates, hey, maybe the Fed pauses. I mean, I don't take a lot of stock in the probabilities, the Fed fund futures probabilities, but they've been rocking back and forth. Right. And I do monitor those probabilities based on the futures market and how investors are reacting, how, what the stock market is doing. And yesterday was a great example, like intraday, as the probabilities flip back and forth between a pause and a cut, stocks really responded to that. And even this morning, when the probability dropped dramatically, with like 26% from earlier this morning, it was like 60. Stocks began to rally, right? So stocks want a rate cut, right? Investors want a rate cut. They want easy money, and that easy money is going to go right into the market, right into risk assets. So,
no, I agree. I think that's the big thing that I think a lot of people don't understand. One is, when we're looking at this, I'm not saying like Ian and I we don't know the immediate future. Let's say, for example, I don't know if the Fed cutting rates will make risk assets go up tomorrow. But what I do think is the Fed cutting rates will make risk assets go up and commodities go up at some point in a very big way, and that's probably within the next 6 months.
Yes, and bonds will go down.
Yes,
Bonds will continue to go down. And the thing about the rate cuts, okay, let's say they pause next month. Powell's time is limited, right? The clock's running out. Trump will have his rate cuts.
Yep.
You know, that seems like a given. It's just a matter of when. So if, you know, Powell holds steady for the next, I don't know, 6 months or until May, like, man, like whoever is appointed in his place, I think they're going to start cutting big time.
Yeah. No, for sure. And I think that's where we're at in the cycle at the moment, right, man? I mean, it's like when we're looking at this cycle and it's like screaming that like no matter what, rates are getting cut, you know, no matter what. Any way you look at it, rates will get cut. So if you were looking at that and we're looking at like, okay, let's go back, because people think rate cuts all automatically lead to lower inflation. I don't know where the hell that started coming from, but people have been telling me that lately, and I have no idea.
I think because in the past, rate, you know, I mean, we haven't been in a real inflationary environment like this in a while, right?
Yes.
So I think a lot of investors just aren't familiar with it.
Mm-hmm.
And then plus, like, usually the Fed comes in and cuts rates when the economy's in trouble. At least that's my understanding.
That's what they say they're supposed to do.
Right. Well, I mean, the economy's pretty resilient.
Yeah.
So
economy's been pretty resilient, and the stock market has continued to go higher. And like, if you were thinking about this, like, you know, 5 years ago, and I was like, Ian, we were on a video and we'd go, okay, it's 2019, let's say, and we go, okay, what would be a scenario where the Fed would cut rates? Well, the market would probably start coming apart in some way. Okay, that makes sense. Well, you know, gold prices would probably be, you know, around that year, maybe $1,000. Okay, maybe the Fed starts to cut rates at that point. And then you'd say, okay, or the economy's in trouble, or, you know, there's some bank blowing up, or something. Like, you have a bunch of these reasons, right? However, today it's like, well, what's exactly the reasoning? Well, you know, we're looking at unemployment at some point being bad. That's what they're saying. Okay, that makes some sense, I guess. Inflation, you know, we're not looking for a 2% target anymore. We're gonna move to possibly 3% at some point. Okay, you know, like, it's very like they're shifting gears so much here, and that's what's kind of hard to, I think, comprehend for most people, which is this: if inflation is sticky and the Fed is cutting rates, does inflation go lower? The answer is no. The time frame, I don't know. Maybe the market's coming apart here. Maybe there's a liquidity issue in the market here. These things can happen, and then things will get sold off. But any way you look at it, off that low, what's going to lead the way? Commodities. Like, any way you look at it, like if you say like, okay, the market's going to come down, I think commodities will still have the most relative strength. I think if you think the market's going to come down, I think sectors like the energy sectors and lithium and, you know, gold miners and so on will probably show the most relative strength. So either way, like, I think you still want to be in these areas, whether you're looking at it as short-term pain, short-term deflationary sell-off. Sure, those happen. But I think long-term is like, if you're a long-term trader and you're really looking at it, you really got to look at these sectors. So let's hop through some of these that you brought today. We'll come back to these. Actually, here's one I actually brought just for you. I was like, I gotta show. I don't know if you've seen this. I posted this once or twice, but it's like, I gotta bring this for Ian, because it's like, this is like literally the setup of a lifetime here. Looking at this Bollinger Band squeeze. Now, I want to highlight this for people because I got a couple questions about this chart recently, which is, okay, why didn't this work in 2020, let's say? Number one, Bollinger Band squeezes do not tell you like the direction of a move. They tell you when a range is tight. So if you're looking at something and you're saying, okay, let's say it's XLE and it's trading between 90 and let's say 88, and it does this over the next 6 months, like, it would be similar to this kind of band squeeze scenario here. So what that would tell you is that a big move is coming once we get out of that range. So which way do we get out of the range? So in 2019, that actually broke down, I think, coming into 2020, right before it predates the COVID crash. So we basically broke down, I think it broke below 50 in oil, and that breakdown scenario there. So that actually did work because that's a breakdown. It's either a breakout or a breakdown. Here today, like, we're kind of making these higher highs, higher lows. We have this long-term, this is a monthly chart, long-term continuation pattern, looking at a possible breakout to the upside. So I think, like, once this thing breaks out, and I would be betting on more upside here, that it's just not going to look back. So, you know, this is just something I wanted to show you for a second, because I was like, this is totally like a chart Ian would be psyched on as well.
It's a great chart. It really is. What's interesting, that breakdown you were talking about, in 2020, gold was leading the commodity complex at that point, and peaked somewhere in the vicinity, maybe like three or 4 months after this commodity chart bottomed, mid 2020. And then that big rally in commodities, I mean, just the rest of the commodity space kind of followed through. And I think we're going to see something similar here in the coming 3 to 6 months. We're going to start to see crude oil. We're going to see copper start to move, and you know, actually hold above $5 and continue to roll. You know, aluminum, tin, they're going to follow. So that's kind of where my head is here. And what I think is really interesting too is you see that, you know, as gold has been leading the way over the past year or so, commodities as a whole have held, right? They're in that tight range for the past few years. So yeah, it's gonna be interesting.
Yeah, I think it's something that we've got to continue to look at here. Sorry, new controls on here. Everything's getting I can't believe how weird everything is on StreamYard today, but we'll get through it, guys. We're here to do it. So getting to the next one, copper versus the S&P 500.
Yeah, so
what are we looking at here?
So I was just looking at the fact that copper hasn't even begun to outperform the U.S. benchmark. So I mean, we haven't begun to see relative strength here, which is you know, we saw I don't know, not 10 years, but say 8 years of relative strength during the last commodity super cycle. So there's a lot of ratios, relative strength that really hasn't caught yet. And I remember in 2023 and even, you know, most of 2024, when gold had already begun to rally, flipping through all my relative strength charts, my ratio charts in my precious metals deck, and not seeing any of those ratios start to follow gold and to resolve higher. You know, silver miners relative to silver was one of those. Now we're seeing it. You know, now we're seeing it, and gold was flying to 4K. I think it goes much higher. Obviously, I think it can go higher in the short term. But I think as this commodity super cycle progresses, we're going to see this line go up and to the right. It's not a negative thing for stocks. I don't, you know, these can, you know, stocks and copper can both do well. I mean, they both did well during the last cycle. The question is, what stocks did well? What stocks outperformed? What equities outperformed during that the commodity super cycle? That was emerging markets. And yes, I think this year we've seen some big moves in emerging markets. You know, EPU, the Peru ETF, Vietnam, VNM. That was a great trade we had on the trading desk. South Africa.
South Africa. Yeah.
South Africa. I mean, was Sibanye Stillwater? I mean, what a move in that platinum.
Latin America.
Latin America. Yep. Latin America is you know, violating a you know, multi-decade trend line.
Yeah.
So there's these are just the kind of things we're thinking about. That doesn't mean sell the US. It's not Sell America. It was very popular. Was it like in April and May? Like the whole Sell America, sell bonds, sell US stocks, sell the
Yeah.
dollar. It sounds great. It's a great headline. It captures a lot of eyes, but I think that the better headline is just buy emerging markets. Right?
Yes.
Make a little space for emerging markets. You don't have to go all in, but definitely add them to your portfolio.
So, and selling America, it sounds good, but it's just a. Do I think America is going to be in this massive downtrend as opposed to the rest of the world? And it's no. So Ian brings up a great point here. If we look at copper moving up here against stocks, we get that recession that happened, and that's where you have this bottom here start to form. And then once we get out of the recession, copper was massively outperforming U.S. stocks. But that didn't mean U.S. stocks went down. They actually went up, but it just was at a much lower rate than everything else. During that same time frame, China went up 300%. Latin America went up 600%. Some of the countries went up more like 1,000 to 2,000% in Latin America. It just means like we're looking for a shift here into these areas. And also looking at this year. This year's a great example, and I'm glad you brought that up, Ian, which is if everybody goes back and just studies this year and what the market's been telling us all year long and how everything has gone, it's been telling us since the beginning of the year that emerging markets were going to do well. And they have. Even last year, China did pretty well last year. The dollar started coming down heavily. That's something that we could talk about a little bit more. I'm sure everybody would be interested. I don't know if you brought a dollar chart. I didn't. I actually did bring one today.
I didn't either. It is an interesting chart. I think that the dollar is the monkey wrench in the emerging market trade right now. And when you look at some of these emerging market charts, I mean, a period of consolidation, a correction, whatever you want to call it, definitely need to digest some gains. It would be healthy for the longer term rally if we see emerging markets cool off. And a stronger dollar would that would be the environment where emerging markets would start to consolidate and contract. So, yeah, interesting.
Yeah, I think that's
a very interesting chart.
Yeah, man, I've taken all the yield curve charts and I've used them on all these different markets over the years, and one of them that's interesting is the dollar. So when we look at the dollar, we're basically these red arrows are showing when money supply is tightening, meaning we're going to more of a bear flattener, which means that most of the time the Fed might be raising rates in that type of environment, or they're just keep pausing and keeping them flat, and the long part of the curve is underperforming. That usually leads to tighter money. And so when we have tighter money, and why that leads to tighter money, this is significant, is if we're looking at banks are able to borrow at these lower rates at the short end of the curve from the Fed and so on. So they're borrowing at, if rates are at zero like they used to be, they're borrowing at around a 0% rate. They're lending it at whatever the 30-year was at that point. Let's say it was around 3%. And they're making the middle on that, which is a lot of money. So they're able to make a lot of money by doing that. And that means they're lending out more money. And they're investing in more things and so on. And they're taking out their own loans and leverage and so on. And so that's what kind of creates this, the boom and bust cycle in markets. And now today where we're in a bull steepener, meaning the Fed is lowering rates. The 30-year is hanging out way up there like we showed earlier. And so that if the Fed rate is lower than the 30-year rate, they're able to lend money out. And so now that makes the dollar weaker. Now, is it going to go straight down? No, just like it's not going to go straight up either. So if you look at all these, you see it's like, yeah, it's moving up at certain points, but it's also moving down at certain points within those primary trends. Right now, I believe we're in a primary downtrend, and not even I believe, like we are in a primary downtrend. It's just obviously we're going to see bounces within that primary downtrend. And like you said, seeing some of these like countries that have gone up, this is a country ETF going up 60 to 90%, some of them 100%, like these are country ETFs. They should not be doing this. So like that they pull back and like money's going out of them and into dollars for a minute and they're consolidating. It makes a lot of sense. We just want to see that those hold. Like, will they hold their consolidation? Will they hold their pullback? And then we can kind of make our assessment from there. To me, the dollar is like, there's a significant level around 101 for the dollar. If it really gets above that, I think that's, maybe it's going to bounce a little bit higher. But for me, I don't think that we're going to get back to those like 107, 110 levels in the dollar anytime soon. I don't think we're going to get into a primary uptrend in the dollar again anytime soon. I do think that we're going to continue to move lower in the dollar, and that's completely my reasons why. Yes, there's other reasons. There's global reasons, like people moving out of dollars, like money moving into international. A lot of different things to go into this, but I really think like liquidity is always the primary mover of the dollar. And as long as we're seeing liquidity move in a way that's positive, the dollar should continue to move lower.
Yeah, absolutely. And it's that liquidity that's going to, move the overall market. This is a great chart. I agree. I think the dollar is definitely headed lower. I was looking at that 101 level. Man, it looks like it wants to break out and move, but when you zoom out on a chart like that, it just looks like a hard retest.
Yeah,
a hard retest of that breakdown level. Again, let's see what happens. But yeah, I mean, emerging markets, even developed Europe. When the whole sell America, when that was hot in the spring, God, I wrote something for Truth and Trends. It's a little cringeworthy now, looking back, and it happens all the time when I look back at something that I've written months ago. But it's obnoxiously making the point that why would you want to buy big U.S. tech? Like, why would you buy NVIDIA when you could buy the German DAX, right?
Yeah.
Or you can buy some of these, and
because it doesn't sound sexy, Ian. That's the thing. Like, these people, it doesn't sound as sexy. Like, NVIDIA sounds sexy, but it's the same as like gold miners. Buy some gold miners. Well, why? Well, they're up 130 or something % this year, and some of them are up 1,000, and they're making a lot of money. And really, it's still like, well, that doesn't sound as cool as like, well, I'm over here at my house. I'm on my MacBook. I have my Apple phone over here. I just bought this new thing from, like, you relate with these brands, and then you put that into your trading, and that's the wrong way to trade. If you can just kind of be outside of it, like I have all these people now will be like, oh man, I should have gotten those gold miners back then. When you were talking about it, I just couldn't. And it's like, I understand it's because it's just different. It's something that more people should be looking at, like fixed income, currency, commodities, gold miners, all these commodity based sectors that make a shit ton of money. They make a shit ton of money, probably more than all these other stocks we're talking about. They're much smaller, meaning they're going to have higher beta. Meaning, if you're looking at something like NVIDIA moving another 2,000% isn't going to happen. But one of these small gold mining names, that could absolutely happen. One of these small stocks in some of these countries, that could absolutely happen. So I think that's things that we should continue to look at here and have an open mind to as traders. So next chart. Go ahead.
They're the new growth stocks.
Yes.
I mean, they're the new speculative growth stocks. Yeah, yes. 100%.
Can't make that much money on stocks that are $5 trillion, let's say. Like, you can, like, not saying you make zero, but you'll make money, but just you'll make a lot more money on smaller names that are a little bit more speculative. So getting into this one, love this chart. Crude oil, S&P 500. What are we looking at here?
I mean, crude oil relative to stocks. It's just retesting levels that acted as major inflection points in the past. The first green arrow down at the bottom of the chart there, that's that was the 1999, so right before the dot-com bubble burst. And then we have there where crude oil trades below zero. Can this ratio continue to fall? Yes, absolutely. I wouldn't be surprised if it does. However, I think the next major move will be higher here, and you'll see crude oil start to catch on an absolute basis. And all of it's distillates, heating oil, gasoline, We're already seeing natty gas start to move. Even though we're in a seasonally weak period for natural gas, and it actually just gets weaker over the next couple months. Again, maybe energy just chills out for a little bit and then really kicks into gear early next year. But I definitely think that crude oil is just something you got to have on your radar, whether it's USO, XLE, XOM. We're looking at Chevron, CVX, or if you're looking at other names like Devon Energy, DVN, or RIG, if you want to get really speculative. Transocean's always a fun trade.
Yeah, the old Tidewater and all those. I mean, there's so many wild names in that space that used to be like bellwethers almost. Like, I mean, it's interesting. But no, like I agree. I think it's, the international energy names also look really good. BP, Shell, like these look even better. Baker Hughes has been doing really well. So, I mean, we're looking at this under the surface at the moment for energy looks interesting. It's not like a buy across the board. It's if you're finding some names with some major relative strength, I think there's nothing wrong with buying that. But I think waiting for like real confirmation on something like the XLE getting above, it was 97, 98 area. If you're looking at monthly close, you're looking at about 97 or 101. That's another huge level. That's the highs from, I think that was 2015. So, if we get above that level, I think this thing's taken off and not looking back. But crude oil, man, it really has to do something, like people keep pointing to my one chart of like gold, copper, and crude oil and going like, man, you were wrong about crude oil. I'm like, it's weird. I don't own crude oil, but it's, to me at the moment, like that's the way to look at it, which is like it will move. Like I don't see a scenario where you have all these things we already named: gold miners, silver miners, platinum, palladium miners, copper miners, lithium stocks. We have the uranium miners. We have the nuclear stocks. Then we get to coal stocks. Like, I could go on, but seeing all those moves, seeing all those starting to make headway higher, I can't see a scenario where energy doesn't go with it. And I think natural gas is the first one to really start saying like, hey, we're ready here.
We're going.
And some of these names are also saying we're going. So I think this is a great thing for everybody to have on their radar. Should be a chart really in everybody's chart book to just go through day to day and be like, okay, is oil actually going to start outperforming at some point? When you see that thing really turn up, like that's going to be crazy, and there's going to be a lot of money made there. And I think it's the cycle that we're in.
It is 100%. And if you're betting on a weaker dollar and you want to get long energy, I like stocks like PBR. Because they're it's just like it's juice, right? It's the juice. So emerging markets, so the petro, I'm gonna butcher it. Brasileiro.
Oh yeah,
Petrobras. Petrobras. Yeah. So
Petrobras. Everybody thinks I can speak Spanish because the way I look, I cannot speak Spanish. I'm sorry, everybody, but I am definitely not can't speak Spanish. A little bit of Italian, really not good at that either. Really not good at different languages. I'm such an American in that sense, but go on, Ian.
I think it's just a great play. And earlier this year, like one of the best calls I made was on Sibanye-Stillwater, and part of that thesis was bullish energy or not energy, commodities. We're in a commodity super cycle. The dollar was starting to break down. It was weak. And it just fit both of those. It was long metals, long commodities, and short dollar. So yeah, I love the emerging market commodity trades. That's where my head is right now.
Yeah, no, I agree. I think it's something that everybody should be looking at the moment. Looking at natural gas, though, you just mentioned natural gas. This is interesting. So looking at these peaks, what is this, every 4 years? It's every 4 year cycle.
So
I never did much cycle work on natural gas, and like I'm so
it's
glad that you did this because
amazing. Yeah.
I never have because of all the volatility in it, and I was like, there's probably no cycle.
What's
Like,
great about
there
this,
is.
what's great, and then for to be clear, like I'm not saying that natural gas is going to peak next year. It might, it could run in peak in 2027. I don't know, but there's a rhythm and there is a rhyme to the markets, and natural gas just really it tells this story. And what's wild, and I know I've shared this chart with you in the past, I didn't bring it today, but you can overlay Minneapolis spring wheat with natural gas and they look so similar. You can overlay Chicago wheat with crude oil. They peak and trough together. You can overlay nickel futures with corn.
Yep.
So it's just that's how these assets move. We're in one of those cycles where there's a boom and bust cycle for commodities. It's probably going to last another 5 to 10 years. I see natural gas definitely moving higher here. It's just a matter of how high. So with the cycles, it helps with where assets may peak or trough, but it doesn't really give any kind of indication or any kind of clues onto the amplitude of those peaks or troughs. So who knows how high natural gas will go? Maybe it'll take out the 2022 peak. I don't know. But I think we're headed higher.
No, I agree. I think here's an interesting place to be looking at this, because one is you saying 2026 actually makes a lot of sense. Just I know like, once again, cycles are they're an estimate. They're not exactly like we're not going to probably peak at a perfect day and time in 2026. We just know around that time it might peak. So I could see a scenario here, and this is what I do think is kind of coming, is like this inflation being so under the surface and just kind of ready to move higher at any moment. Next thing you know, natural gas starts to move. Nobody cares because, even though natural gas is a weighting in the CPI and the PCE, it's not that big of a weighting. So let's say natural gas starts to take off, doesn't look back. Nobody's going to care. It's not going to be a big thing. Natural gas could be around $10, and then people might say something about it.
Yeah.
Then we get to the next one, which is crude oil. Then that's when that starts to really take off, and people probably start caring, and it turns into the Fed maybe pausing, raising rates, doing something differently to start to fight inflation in some sense.
But yeah, if that's where we are, late spring, early summer next year, that's where we find ourselves. So we find the markets. I don't know. Like, that's why I think commodities are just going to absolutely skyrocket. Is because, like I said, Trump wants his cuts. And he wants, and I don't know if you follow, I know you follow the news, and over the past was like 6 or 7 months, where it didn't matter what the data was, right? It didn't matter what the CPI number was, or what was reported for non-farm payrolls. If it was positive or negative, right? It didn't matter. The message was rate cuts.
Yes.
Right. And it was kind of comical because, the administration would have, one reasoning 1 month for the rate cut, and then it would completely change the reasoning the next month. And it's just, that's it, like cuts. So I don't know. I think we could be in a situation where, mid-year, where inflation is rising dramatically, and we don't get the hikes. We don't get the tightening. But we'll see. Who knows? I have no idea. It's just based on what I've noticed over the past year or so.
Yeah, no, I totally agree. It's just like, let's continue to watch this. We'll be data dependent, just like the Fed. We'll watch and we'll react. But no, like, I agree. That's my biggest thought, is they're going to run this hot. Like, they're going to run it hot. I don't think they're going maybe get rid of everybody who has a voice that's hawkish, continue everybody dovish. And next thing you know, like they're just going to run it hot. And I think that's what they want. I think the Fed's become a little bit too political at the moment. And that's probably what's going to happen. And really, at the end of the day, the only way to handle our country's debt is to have that much inflation. That's something that is very, exactly. Yeah. Exactly. It's the only way to do is print it away, inflate it away. And Richard Russell would always have it's one of my favorite quotes of all time. It's inflate or die. Like he'd say that the Fed has a choice and they can either inflate or die. And so like I think that's where they're at right now. It's like if they start to just go, hey, we're going to raise rates, we're going to fight inflation, like they're dead. The country's dead. There's a lot of things that are dead. And it's not because of the economy. It's not because of jobs. It's not because of this or that. It's because of the debt. And that's it. I'm not saying like run for the hills because we have debt. I'm saying that the only way to really get rid of that amount of debt very quickly is to have massive inflation and let inflation run hot for a little while. And I think they're ready to do that. I don't think they're going to hide away from that. So got a question, Ian. Will silver outperform gold from here?
That's a great question because it really hasn't. Not on when we zoom out and look at the silver relative to gold chart. I mean, it's just a massive base. And that's one of the risk on ratios in my precious metal deck that I was mentioned earlier that has not resolved higher yet. So that tells me that we're still very early on in this cycle. I do believe at some point silver will outperform gold, and that will be an incredibly risk on environment for commodities in general and metals. Silver 73, and then maybe after 73, 120, just off the top of my head, and then who knows where it goes from there.
Yeah.
But that's something to think about. And I know that that's something that we talked about before we jumped on this call, Jason, that we wanted to highlight. I especially wanted to highlight is being in the frame of mind that commodities could go much, much higher. $28 soybeans could be the next ceiling. Cocoa, coffee, these commodities could just be in the stratosphere. So that's just something, something to think about moving forward, especially as we begin to see a rotation out of the big tech, which we're seeing it now, out of big tech, or even like out of that speculative AI, like flying cars and the quantum computing and all of those names, which I like. I mean, they've amazing trades. They've definitely been catching lower recently. So I think as stocks find their feet, as the averages find their feet and start to resolve higher, I think we're going to start to see that rotation. And we were not going to see tech lead again until we have a more serious sell-off.
No, I agree. I think that's what I think we're seeing here, which is we're seeing that overvaluation of certain things kind of come into play. Into areas that have been overlooked for a long time, whether it's gold miners, commodities, and so on. These commodity-based sectors have been massively overlooked. If we're talking about the cheapest market, if you really want to do fundamental research and look at the cheapest thing in the market, the cheapest thing that you can buy in the long run, which is commodities, right across the board. Like do a chart of for you chartists out there, do a chart of the S&P 500 to commodities and go back as far as you can. You're gonna definitely see like we're certainly undervalued in the commodity complex.
Yeah.
But all right, guys, we got to get out of here. Thank you guys so much for joining us today. Ian, as always, man, just a blast to have you on here. You're always welcome on here anytime, dude. I love to have you on here. Great charts. Everybody enjoyed it. Thank you, man.
It's a pleasure. Thank you so much for having me.
Of course.